Here's what's coming up on today's show.
You don't understand those mutual funds any more than you understand the oil partnership, but for some reason, you're scared to death of the oil partnership. And this is just education you have to give people.
This is the Retire Happy podcast with John Amarino, a fiduciary financial advisor at Securus Financial in the San Diego area, and Thomas O'Connell, president of International Financial Advisory Group, Inc. in Parsippany, New Jersey. Together, they'll be keeping retirement happy from coast to coast.
Welcome back to another episode of the Retire Happy podcast. I'm your host on the West Coast, John Amarino, and I am joined by my esteemed co-host and great friend on the East Coast, Mr. Tom O'Connell. Tommy, how you doing?
I'm doing great. How you doing, John?
Good. Congratulations to your Yankees on making it to the World Series.
It was a great day. And sorry that your Padres are golfing with the Mets, but
yeah,
could be worse. They could be golfing with the Red Sox.
Listen, I mean, honestly, outside of LA and New York, no one really cares or wants this World Series. So enjoy it. Just beat the Dodgers. Sorry, all you LA listeners.
So angry.
Yeah. So, anyways, we're all doing good, and hopefully, the Yankees win. So, folks, on this episode of the Retire Happy podcast, we have a great topic that has been asked about by some of our clients. And it has to do with oil and gas investments. And folks, before we introduce our guests, I really want to get this out there. Oil and gas investments carry a large degree of risk. So we want to make it perfectly clear, and my compliance people will be smiling right now. We are not giving any advice to jump into this. We are giving you a strategy, and we're going to talk very conceptual, and we're going to really focus on using oil and gas as an investment to address and mitigate taxes. So it's not advice, but our goal here is to really give some education and the benefits and obviously with the risks, the good questions to ask or be aware of. So Tommy, did I miss anything on the compliance stuff?
No, I'd like to reinforce your point that we're going to be speaking from a very high level, 10,000 foot view of what gas and oil investments are, the positives, the negatives, and mainly why it's used for most people as like you said, a tax mitigation strategy. Please make sure you don't take this as personal advice and speak with your accountants and attorneys and all your other advisors before you do anything. This is not advice. This is idea and strategy.
Yeah, and this takes a team, like you said, advisors, experts, accountants. So,
Right.
All right, we beat that in death. I think our compliance is happy with us now, Tommy. We did our
Clients is
job.
never happy, but okay.
So with that, we'd like to introduce our guest expert, Bruce Wehner. And Bruce is the Chief Cash Flow Strategist and Lead Advisor for E3 Wealth. And he leads a team of highly skilled and integrated financial professionals operating on a family office model. And we'll get into that in a little bit. And what they do is they offer strategies in various areas: cash flow management, business development, investment, insurance solutions, and tax reduction. And Bruce is also the co-host of the Money Advantage podcast. So without further ado, we are very excited to introduce Mr. Bruce Wehner.
And today's guest, the Chief Cash Flow Strategist for E3 Wealth, it's Bruce Wehner.
Don, thanks for that nice introduction, and I hope I can provide a lot of value for your listeners today.
We have no doubt that you will.
Yeah, and we're excited to have you on because there's a lot of buzz and interest, especially in today's tax environment. Although we're in a low tax environment, I think Tommy and I have talked in nauseum about 15 months from now and 2026 and how the Tax Cuts and Jobs Act is most likely to go away. And we're at a point of maximum financial or maximum tax risk, lowest tax rates in history, skyrocketing national debt. So there's a lot of Tommy and I have talked about clients who have a lot of interest in trying to mitigate large amounts of taxes now and take advantage of the low rates before 2026, and then obviously having to mitigate taxes after 2026. So we're excited to really dig into your knowledge. So Bruce, would you mind just giving us, obviously we talked about oil and gas in the intro. Tell us about oil and gas as investments and how it's commonly used.
Yeah, so when people come to us for solutions on the tax side and on the income side, either to increase their net worth or to have income for retirement, we often look at what can an oil or natural gas partnership be used to actually solve those two problems. And a lot of times people are always looking to grow their net worth through appreciation. Well, you're not going to do that with an oil or natural gas partnership, because there is no appreciation. There is no net asset value. There is no tangible thing that you can sell at an appreciated value to get out of. So the first thing you have to understand, you were asking about the cons of this, is that whenever you look at where you're putting your money, you're looking at safety, liquidity, and growth. Those are the three things that we always focus on. Liquidity, there is no liquidity. Okay, so, and if you understand business, you understand why. But not having the liquidity actually gives you the great tax benefits. So I think we ought to start with, how do these tax benefits get in place in the first place? So I'm sure all your listeners, because I've known Tom for years and years and years, and your listeners know that the income tax code was placed here in the United States in 1913. And at the same time, in the tax code, there was written an incentive called the intangible drilling cost, or we normally refer to them as IDCs, intangible drilling cost. And so this isn't something new that Congress decided on. This has been in the tax code since the very beginning. And why does Congress put any incentive in the tax code? Because they're trying to control the actual behavior of the people of the United States. Well, they wanted more investment into fossil fuels way back then. And so they did that. And it survived the tax code ever since. So what is an IDC? An IDC, if you think about it from a business perspective, it's the cost to get the commodity out of the ground, whether it's natural gas or whether it's oil. So what a partnership will do is they will collect a pool of money, and then they will use that pool to actually drill the well, whether it's oil or natural gas. And what are some of those costs? Well, the cost is either the acquisition of the land or the lease cost of the land. It will be the labor cost to drill the wells. It will be the lease cost for the equipment, whether it's the actual rig or the trucks that bring in the equipment. It will be the insurance that you have to have on these. So whatever cost there is in a normal business, you're actually going to have when you drill these wells, including very consumable things. Think of drill bits. So they're drilling downward. So a common misconception is we want oil to be as high as possible as far as commodity costs to actually benefit from this. And if you understand this from a business standpoint, what happens when a commodity gets really high is everybody and their brother then becomes an oil person. So when they now think, oh, well, oil's really high, I'm going to get into the oil business, what does that do to labor costs? It actually drives them up because they're competing for the same amount of labor. What does that do for land acquisition? It drives it up because you have a lot more people trying to acquire the land. What does it do for lease costs, whether it's for the equipment or for the land? It drives it up. So if you look at it from a business perspective, You're actually trying to get the oil or natural gas, the commodity, out of the ground as cheaply as possible. And that will actually help your return as far as the commodity. Now, what happens on the tax side, they say any cost that it takes to get out of the ground, just like any business, you could write it off your taxes. So the people that are investing into this, let's use $100,000 because that's mostly the minimum to get into these particular partnerships. So you give them $100,000, depending on the partnership, you're going to be able to write off anywhere between $70,000 and $90,000, or 70 and 90% of whatever you gave them in that particular tax year. But here's the kicker. It's against any type of income. So unlike real estate, you have to be a real estate professional to actually write off against your income. And you can take a loss if you can prove you're a real estate professional. But if you're just investing in the real estate, you can only write off against your income. Where here, you can write off against any income. So that is a really big advantageous part that they have. So let's talk about the example. You have income of $200,000. You invest into one of these at a minimum of $100,000, and it gives you a K1 the next year, just like a business. And it says, we had costs that were prorated throughout the partnership. You get to write off $85,000. So now instead of paying income on $200,000, you subtract 85, you only pay income on $115,000. However, your entire $100,000 now is in the partnership, and you're going to get a return on all that $100,000. And then before I open up for questions and more clarification, the income you're going to get is also tax advantaged, because as you're taking the commodity out of the ground, what happens to the value of the ground? It depreciates, and they call it depletion allowance. You're depleting the commodity out of the ground, and so you actually get another 15% off of your income. So any income produced, you do not pay 100% of ordinary income on it. You only pay 85% of ordinary income.
So as an example, let's say your dividend, it's not a dividend, right?
It's a dividend from the partnership.
Okay, so you get your dividend, it's $10,000. You're only going to be taxed on 8,500 of that.
Correct.
Right.
Correct.
Okay.
Correct.
And Bruce, you've said partnership a few times. Are you as an investor, you're not a stockholder, you're a limited partner in this?
Actually, great question, John. So you go in order to get the tax benefits, the tax code says you have to be a general partner. So you go in as a general partner to get the tax benefits. And then what the partnerships do, but when you go in as a general partner, you assume all the liability of the partnership. Now, the liability is only as high as your percentage of the partnership. So example, if it's a $250 million raise and you're at 100,000, your percentage of liability is only 100,000 of the 250 million. So, but these partnerships then go out and buy liability insurance. And if something were to happen from the ecosystem, or if a rig blows up and a couple people die, then you will actually be on the hook for that. However, the partnerships that we work with are covered by $200-300 million of liability coverage. And none of them have ever even used their deductible. So they actually they want to be good citizens in the state that they're drilling. So they're actually taking every precaution possible to minimize that liability.
Yeah, this isn't like wildcat oil rigging that we saw in the 1920s, on TV, that we see on television these days and everything like that.
Tom, that's really good. Yeah, this is highly engineered extraction of oil. And Tom, if I don't remember, bring back wildcatting again later on, because that's going to be a really important con that we talked about. But then, John, what happens the second year after you get the intangible drilling costs, they actually flip you to a limited partner. So the only time you actually have any kind of liability is the first year, and you have to if you want to get the tax benefits. That's according to the law.
Now, Bruce, you mentioned the first year and the second year. I have read that to cover costs that some of the companies could come back to you and say, hey, we need additional capital. How much capital could they ask for, and how often does that happen?
Okay, so another great conversation. So we've all heard wild stories. I'm never getting into oil or natural gas because my brother got in it or my uncle got in it and he lost his butt on this situation. And wildcatting, Tom, there's another one where people are looking for that pocket of oil that they can get, and they're only going to drill 1 to 4 wells looking for this. We don't play in that game, okay? And I would suggest most people shouldn't play in that game. You should actually play in the known reservoirs. Now, the upside isn't nearly as high, but the upside's pretty good. But the risk mitigation, John, is very, very limited. Now, what you were talking about is coming back for a capital call. We've been doing this for 12 years, haven't even come close to a capital call, and here's why. We represent 4 of these partnerships, and none of them, 0 of them, have any debt. They don't use any debt. So when you don't use any debt, what they basically do is they just drill until the money's done. And so these other ones, they're actually using leverage, what you're talking about, by going to a bank and getting part of their capital from the bank. Interest rates might spike, or they don't get the same kind of returns coming out. And they say, oh, well, in order to do our next well, we need to pay the bank note. And we ran out of money because we didn't get the type of return. So now we need more capital to do the next well and the next well. So if a con or something to look for is to make sure, in my opinion, you work with programs that are not carrying any debt, and they are also working in known reserves, such as the Permian Basin or the Marcellus Shale Basin in Pennsylvania. There's a couple of other ones that you can work in that are known reserves, but I would say those are 2 cons that you should try to avoid.
Some of or I guess all of the companies that you deal with in this regard, going back to wildcatting, single wells, you and I had spoken about this in the past, that they have many multiples of wells. So they're not just dependent on a singular or just a singular well.
Yes.
You're talking about multiples and multiples, which again, like a mutual fund, right? The more stocks you own or the more bonds you own within that fund, the more you're mitigating that singular risk.
Very good. So the least amount that are drilled in the funds that we're involved in is 40 wells. The most is 100 wells. But even that doesn't completely mitigate risk. But what has mitigated risk the greatest is the sonar capability. You're in a known location, and the fact that now they can drill down a mile, they can turn the drill bit and drill horizontally for another mile. Now, and I'm excited for the next iteration of this technology, is they're going to now be able to turn the bit again and drill back for another mile, basically just weaving across known areas looking for pockets of oil. And since 2014, the 4 partnerships that we represent have drilled 0 dry wells since they've done that. So it's not that they can't. And if you read the perspective, which is about that thick, they're going to scare you to death and say you can lose every one of your premium that you put in. However, I tell our clients, okay, then those mutual funds you love, I'm going to actually get the perspective and make you read that too, because they're going to tell you the exact same thing. You don't understand those mutual funds any more than you understand the oil partnership, but for some reason, you're scared to death of the oil partnership. And this is just education you have to give people.
Right. Now, so to that point, one of my questions is, back in the 80s, there was a lot of this, right? And then Reagan came in and he turned the tax code on its head a little bit. You saw people with commercial real estate go bust, Fisher Island down in Florida, for example. And then you saw a lot of this industry get turned on its head as well. So what's the difference between then and today?
Great. So we always talk about political risk in this situation. And so if you remember President Trump a few years ago when he was debating Hillary Clinton, he was talking about, well, you were a U.S. senator. Why didn't you change the tax code? And he said the reason you won't change the tax code is because all of your friends are also doing this. And so we take the same. We know a lot of Congress is already invested in oil and natural gas. And so the political risk, although it's always there because we all know they're all idiots in Washington, it can always happen. But we take the idea that we are not going to go from green to replacing fossil fuels in no time. The next, and it works both ways. You know, Trump keeps saying he's going to say drill, baby, drill. But the oil partnerships, just because Trump says drill, baby, drill, they actually don't want that. They don't want to bring a bunch of supply out of the ground so that commodity prices plummet. OPEC does this. OPEC does this all the time. So that's a great talking point for Trump out on the campaign trail. And then if we want to go to Kamala Harris, she's been accused of, saying no fracking, although she's backpedaling on that now. But they cannot do anything as far as that goes, except on public land. They can't control private land. Well, I guess they can if they want to get into a socialistic or communist type of government. But then who cares where you have your money? I mean, so we tell our clients all the time, you really should be making your decisions based upon what you think the government's going to do, because they don't really have the power to do it, even though they tell everybody they have the power to do it. And if they figure out a way to do it, it doesn't make any difference where you have your money anyway. We're under communist rule. So that's how I would talk about it.
I think you led with a great point about DC is they're all invested in it. So if they're making money, they have no, it doesn't so much trickle down to us. It's what lines their pockets, but we digress.
Wait, right. You mean those Congress people, they know what they're investing in? You mean those blind trusts? If they don't have all their money in blind trusts?
Foundation.
What?
Yeah.
What?
Boy, we can go off on a whole nother tangent.
Yeah, let's stay out of that. That rabbit hole.
So let's talk about, if you don't mind, because we're kind of on this. So the other thing that a lot of people say, well, what if I'm more afraid of nuclear being brought back to the United States, frankly, than I'm worried about green energy as far as, whether it's wind or solar or wave technology. I'm not really that worried about that. I'm not saying I'm against it. I'm just saying when the sun doesn't shine, the wind doesn't blow, and the waves don't, we don't have any energy.
Yeah.
As far as electricity. Yeah. So the greatest thing to overcome that at a very clean is natural gas. And by the way, I don't know if you guys have seen the projections, but about 2030, they're projecting that we are going to have to double our electrical output here in the United States to keep up with AI.
That's why all these companies that's why Amazon and all these other companies, the AI companies, are all buying up nuclear power plants.
Right.
I forget which one I think it was Amazon wants to restart 3 Mile Island.
Right. I just think they're going to get more political pushback from the United States. And I disagree. I like nuclear energy, but I'm just saying the people in the United States are so scared of it.
Right.
And so the next thing is do natural gas powered plants, which is in the works right now, and natural gas facilities. Now, let's just pretend we start up nuclear, we start up solar, and we have all this great technology. The oil companies and natural gas companies will just offshore to the places that don't have this. South America, Africa, places in India. They're just going to sell it somewhere else.
And we become a great exporter and make money.
Exactly. So I'm not saying we're going to get the type of returns that we're getting right now. It depends. But we're not even worried about the returns. I'll digress real quickly, and then, Tom, you can go to your next topic. But also about risk mitigation. So if you're at 100,000 and you get to write off 85,000 and you're saving in the 32% tax bracket, Well, that's 32% of 85,000. Not even talking about the taxes, like you in Jersey, you're probably paying 10+% there. So now we're at 42. So 42 of the 85, I can't do the math really quickly in my head, but it's somewhere around a $40,000 savings.
Right.
Okay, now, so even if you think this could be somewhat risky, you don't have $100,000 at risk, because you were going to write checks to the federal government in the state of New Jersey for $40,000. So right away, you've taken $40,000 of risk off the table by doing this. So now you only really have $60,000 at risk, even though they're going to give you returns on all $100,000. So the cash on cash returns of these partnerships, we feel safely from the historicals that you're going to get all your money back in about 5 years on the cash on cash. And that's under normal historical. I don't even want to go where the last couple of years have gone from the efficiencies, because it won't go through your compliance department when it comes out of my mouth, because they're so good.
So just for the audience, explain what you mean by cash on cash return.
So as we said at the very beginning, you don't have anything to sell to get out of the partnership because your money's in the ground. So all you're doing this is for the cash that you're going to get either on a monthly or quarterly into your bank account from the distributions of the commodity. And so if you said, well, it took me $100,000 to get this particular cash distribution this month, that's the cash on the cash that you put into the partnership. And after about 5 years historically, you're going to get all your $100,000 back. But remember, as I just said, you really didn't have $100,000. You only had $60,000. So now, if you consider the tax advantages, you're going to get all your money back in about 2 to 3 years, not 5 years, because you weren't going to have that $40,000 anyway if you didn't do this.
So let's for compliance purposes, let's make sure we explain to the listeners who can do this. So there's a term called accredited
investors.
So,
yes.
So let's talk about that.
So if you can only do this if you're an accredited investor. And by the way, they are becoming more and more sticklers. It used to be all you had to do was sign that you were an accredited investor. And an accredited investor is a single person making $200,000 for the last 2 years and has a reasonable expectation they're going to continue to make $200,000. What the hell a reasonable expectation is, I don't know. Or a $300,000 for a couple for the last 2 years and have reasonable expectation that you're going to continue to make $300,000. Or if you don't have that kind of income, but you have $1 million of liquid net worth. And the question I get all the time is, well, my house has $700,000 of equity in it. That doesn't count. Oh, well, my business is worth $3 million. That doesn't count. It's not liquid. It has to be something that you can turn into cash in a few days, as far as selling something. And the reason they do that, Tom, is, let's say the distribution isn't very good for you a couple of months. And you're like, I want out of this. You can't get out of this, but you're counting on that distribution. Well, you have to have enough liquid net worth to make up for the lack of distributions that particular month. So that's why they cap it at a accredited investor.
And I want to reiterate something that you just said, and we said it a couple of times already. You can't get out of it. Once you're in it, you can't get out of it.
Yeah. People always say, well, that doesn't make any sense, because people are comparing it to the equity markets.
Right.
And that's because a lot of people have never been in business before. It's just like money that you might put into a business and you lost it. You get to write it off your taxes, but you don't have necessarily anything to sell because people don't want to pay you for something that they've lost.
Right.
This, though, you have the startup costs, just like you have with a business, that you can write off your taxes, but then you're going to have income from the business. Here, you're going to have income from the partnership. It's just that there's nothing that you can sell over here. And that's not, I know there's going to be some people listening to your podcast that are going to say, that's not true. You can sell there's no free market for this. You might be able to say, okay, Tom, my next door neighbor would like to take over this. You might be able to sell the interest to him but there's no trading market for this. And we tell all our people, we tell our people all the time, okay, maybe you can find somebody to take it over, but nobody's going to work with you to do this because there's not a market for this. That's what we mean by you can't get out of it.
All right. And then, for compliance again, right? None of these results are guaranteed, right? It's the technology's there. As Bruce was saying, a lot more efficiencies are in place, but if a well goes, let's take it to the flip side. Go back to Tommy's wildcatting days. If you want me to make the Grandpappy reference for you again, Tommy? Your first job in 1920.
I drove out there in my Model T.
So if the well's dry, there's no money, right? Business goes under.
Yeah, correct.
Okay, so let's use a hypothetical example. That worst case scenario happens. How long do they give that well before they give up? Or you were saying that they might do 1 to 4 drills, on those old wildcats. Like, let's go with the worst case scenario and a contingent before they basically bankrupt the project.
John, I've had people bring these type of things. My own clients bring these type of things to me because they've been presented by their next door neighbor or their buddies at work. And I don't have a good answer for you because I tell them, put this in the trash can because we're never going to do that. So I really don't have the answer for that, but that's where you get the capital calls. And then you can decide, I do know this because I read through the PPM. You can decide that you can put more money in it to continue the drilling, or you can just give up your interest in the partnership. Of course, if you give up your interest in the partnership, then if they are successful, then you're cutting your losses. That's why we never play in that game. We're playing with family offices that at the minimum have been in business for 40 years and the maximum has been in business for 72 years. Now, the other reason we do with the family offices is because the family and the employees put legitimately large sums of their own money into the partnership. And we're talking anywhere between 30 and 50% of their own money into the partnership. And they don't get to cherry pick. So if they do 100 wells, you get a proportion just like the same wells that the family and the employees are getting. So they have an incentive to make sure that this is brought out of the ground. 1, get it out of the ground, and 2, get it out of the ground as efficiently as possible. So then they just roll a portion of the returns into the next year. So they get kind of a perpetual tax deduction along the way. So that's another way to mitigate your risk is that we call it, we want to work with people that are eating their own cooking, so that they're doing that. I've looked at some of these wildcatting PPMs that you're talking about. Just saw one a month ago. It said that the sponsors are going to put in 1.5% of their own money. And I thought, what does that come out to? Well, they were trying to raise $2 million. Okay, so figure that out. They're putting in like what?
20,000.
25. Yeah. It's like, I'm not sure if they're asking you for 100,000 and they're only putting in 20,000. I don't think they're in it together in that situation.
So Bruce, I have one more question on the calls. So let's say that happened. Do you get an additional tax deduction if that were to happen? Like initial investment?
Yeah. I'm not a tax professional and I've never had this asked before because like I said, we don't play in it, but that would make sense because as the businesses I've owned, I'm sure you guys, the owner or your clients have owned, anytime you have to bring more money to the table, it depends on what they're using it for. But I would say, you get additional tax deduction. But as I tell my clients all the time, we better not be doing this just for tax deductions. We also need to be doing this for the income that it could be produced. So we're not looking for things that might produce so we can get a big tax deduction. How many times do you guys have clients that have a business and they say their accountant tells them, hey, you need to go out and buy a piece of equipment by the end of the year so you can write it off your taxes.
Right.
And I'm saying, Do you need the equipment? Well, not really. Well, then that's just stupid.
Right.
You know, I mean, I'm
Yeah.
sorry.
Cash balance plan.
Yeah. I mean, there's just a lot of stupid accountants out there, and including a lot of stupid CPAs if they're giving that kind of advice. And that brings up another thing, John, is a lot of really good CPAs have never had a client in an oil or natural gas partnership, and they don't even know how to take it against their income. We've seen them where they say it's a passive investment, so you only can write it off against your income, just like real estate. But you're actually actively involved because you're a GP. So you can write it off of any. And we've had arguments after arguments with our CPAs with them. We've actually had our CPAs go to the tax code and show them. And, we tell them, hey, you need to get a different CPA because of that.
So speaking of tax advantages or tax strategy, again, you and I have talked about this in the past, Bruce, and John and I talk about doing Roth conversions for people, being that 2026 is right around the corner. So for especially for higher net worth people who are looking to do larger Roth conversions, this could be an excellent offsetting strategy.
Yeah, I mean, this is what we do all the time.
Right.
All the time. So we say, okay, you're going to convert $100,000 into Roth. You do the distribution. You can either put it into the partnership if you want, and then only pay $15,000 on the Roth conversion. But then people say, well, I don't really want to get into oil and gas with my Roth conversion. I'd like to keep it what I have invested. And they say, okay, do you have other cash? Or do you have a brokerage account where you have some losers? So then you can actually do the Roth conversion, take money from somewhere else and put it into the oil and natural gas fund. So you convert this, but now you have after-tax money doing this. And so you can actually do the Roth conversion very efficiently. But Tom, we haven't even talked about this one, I don't think, when we were working very hard at these conferences we go to. We slay from 8 o'clock in the morning till 8 o'clock at night working on this for all our clients, right when we go to these things. But we haven't even talked about this one. You can actually use qualified money with a couple of our partnerships, and you actually give them to the qualified money. After usually 3 to 4 months, the partnership will actually have an IRS approved auditor come in and value the partnership. The auditor will come in and say, okay, what kind of control do you have? You don't have control in you're a GP, but you don't have control in the actual management of the program. So that is actually not good as far as they're running the company. There's no liquidity. So the value of the partnership goes down even further. And then finally, they use reasonable expectations of the commodity coming out of the ground. So because of those 3 liabilities, they revalue the partnership. So they say now your $100,000 is only worth $50,000 because of those 3 reasons. We don't know if you're going to find oil, and even if you find oil, we don't know what the commodity price is going to be. The second thing is you don't have any say in how they're doing the partnership. And then the third thing is the lack of liquidity, which is really, so they devalue the partnership. So they come around and they haven't been producing any oil yet or natural gas. So last year, the target for this one partnership was to devalue at 50%. They actually devalued at 39%. So we then took the 39,000, we Roth converted it, and they only had to pay taxes on 39,000. But then as soon as they started producing in the wells, they're getting the distributions on all 100,000, and it's all tax-free because it's in a Roth. Now, you don't get the intangible drilling costs that year because you can't get it because you're in qualified money.
Right.
But it's a Roth conversion strategy. And then I'll talk about one other one because I know we're kind of running out of time. But another partnership will actually do a QOZ for our clients. Now we're running out of QOZ, right? Because it's set to sunset on December 31st of 2026. I'm actually thinking go
2025.
forward, but 2025. But you're not due until the following April. So what they are doing now is they're taking your capital gain. They're saying, we're not going to give you what the partnership has been distributing, but we'll guarantee you for the next 18 months, we're guaranteeing you 6% distribution on your money. That distribution should be enough to cover your capital gain. So now you're letting the investment cover your capital gain tax. And then for the next 10 years, we're going to give you a 6% distribution that's not going to be taxable. And anything over that, we're actually going to hold on to for that 10 years. And then we're going to make a big distribution at the end. And you guys know QLZ rules. What happens to the distribution after the end of the 10 years? There is no capital gains. So there are 3 different ways that you can use these partnerships to mitigate your taxes. The regular IDC, the Roth conversion, where they devalue because of the lack of liquidity, lack of control, and the fair market price, and then the QLZ, which is we hope is going to continue, but it may not continue.
Wow, that you blew my mind with the last one. That was like bonus coverage right there. I knew about the first 2, not the last one. I'm sure Tom.
I didn't know the third one. That's not something that Bruce and I had talked about in the past.
Well, the QLZ is running out so much, but we just had a person who is a W-2 earner, his publicly traded company. He has been buying stock out of his 401k for 25 years. This publicly traded company just got bought, and they made him sell his $1.2 million worth of stock this year. And his cost basis is $300,000. He has capital gains on $900,000. So he's like, I don't know what to do. And I said, well, you're going to retire, right? And he's like, yeah. I go, do you need income? Yes. I said, well, what we can do is we can actually put this in this oil partnership on a QLZ. They will pay you 6% for the next 18 months. That 6% will be banked. We'll use that to pay the capital gains. If you do the math real quick, right? 54,000 times 18 months, it's going to be somewhere in 100,000 or so. And they actually say they will make up the difference if need be. So they're going to do whatever they need to make up the capital gains, which is going to be about 175 to 180,000 for him. But they'll pay that through the investment, and then it'll just keep getting 54,000 for the 10 years. And at the end, anything over that 54,000 he makes, he gets tax free.
Mine's blown.
Mic drop.
Yeah.
Even though nobody can see us.
Yeah, right. I'm just scratching my head here going, man, that was replay a couple times. So Bruce, you mentioned, how you guys do things, and, we'll talk about connecting with you later, but you also talked about how people have brought those wildcat. And can you just in the last few minutes tell our listeners, our clients, listen, if you are getting into this, these are the things you need to look for, especially the red flags to avoid.
Yeah, the red flag, I've mentioned it, but I want to emphasize it. You got to look at the sponsors and how many years they've been doing this. One of my clients recently brought one to me, and the people were actually, they were in private equity. Well, private equity people think they can do anything, in my opinion. So they were in private equity, and they saw this opportunity, and they said, hey, we're gonna do 4 wells, and we're going to raise this money. So first of all, you need to look at how long have the sponsors been actually doing this. Now, they can say, well, yeah, but we stole this engineer from, so-and-so for 25 years. He's got 25 years experience. I don't care about any of that stuff. I want to know what the sponsors have done, because those engineers can actually see that you don't know what the hell you're doing, and they might get in the project and then they get right back out of the project. So I would say you need to look at these people that the sponsors collective experience is very significant. I mean, I'm talking about where they have 80, 100, 120 years of collective experience from the sponsors of this. So that would be the number one. I think that's the number one thing, because if the sponsors can't pivot, then you're always going to risk really badly lose your capital. The number two thing is zero leverage. Zero. Not a little bit of leverage, but zero leverage. I didn't even talk about the benefits of having zero leverage that happened during COVID. You guys, I don't know if you remember, but oil prices actually went negative. They actually had to pay
For a
the
day.
store. Yeah, they had to actually pay the store. And guess what? They still had to make their note payment. So talk about capital calls. Well, we had some partnerships that did that. All they did was they capped the well and just waited it out. So yeah, our distributions were stopped for a couple of months. However, they didn't sell that commodity at a loss to store it because they didn't have to make a bank payment. So that would be the second thing, John, is zero leverage. And then I think the final thing is that you have to look at these and ask them, what have you done to innovate over the years? A lot of people think fracking. Yeah, fracking is a great innovation, but are they continue to look at horizontal drilling? Are they weaving the horizontal drilling? Are they recapture their fracking water? We have one partnership that once they build the rig to drill, most partnerships have to deassemble it and then take it another 100 yards and then build another one, build it up again. We have one that's actually figured out they can put hydraulic legs on it and walk it across Texas for 100 yards. And so now they don't have the labor costs to take the rig back down, and they can get it up and running again really, really quickly. So you have to have people that are looking at innovation all the time. So those would be the three, I would say, red flags that you have to worry about.
And will a lot of the companies or sponsors that you're using, will they tell the investors, hey, this is how many times we're going to drill, this is how many wells we're going to drill, and like you said, the basins, these are the areas, will they that knowledge be given?
It's all in the PPMs and the historicals. Yeah, and they have to give a range just like anything, right? Because they're going to target $250 million of raise, and if we think that it's going to cost us, X amount to do this, we're targeting between 40 and 60 wells, because they don't know that they have to do a target because they don't know what it is going to be to the labor costs are going to be, the leasing costs are going to be, so on and so forth. So they have to do a target as far as that goes. So yeah, it's all in the PPM.
Awesome. Tommy, any other questions?
No questions. As an aside, Bruce had mentioned he and I have known each other for many, many years. And so for one of the areas that I know Bruce is a specialist in, as well as one of the things that I love most, is the infinite banking. So I would encourage anybody that's listening that has an interest in it or is in it. Bruce's podcast, Money Advantage, is by far one of the best ones that are out there on YouTube or Rumble or any of those social media programs. So listen to Bruce on the Money Advantage podcast.
I appreciate that. And Tommy, just a little plug. So our clients borrow against their cash value. They get into the partnership. They take their tax savings, pay the loan back, and they use the distributions to pay the loan back. And then after about 3 years of doing that, they have enough distributions to actually then have a perpetual tax break every year, because the distributions are big enough to actually buy into the next partnership, all because they had capital in their life insurance policies to actually deploy with no loan applications, that just from their signature.
Wow.
Now you know why I love infinite banking.
Hey, and Bruce, are you
and investment, right? So
yeah, exactly.
And getting back to where people can find you on your podcast, are you also on Amazon, Spotify, iHeart, all the major?
Everything.
Everywhere.
You'll get sick of finding us.
Kind of like sick of the oil drills y'all do. They're everywhere.
You won't get sick of that.
Well, Bruce, thanks for blowing our minds for the last 50 minutes. I mean, Tommy and I will certainly after this say how, there's been a couple podcasts where we were just floored at the information given to us, and we learned a lot, because there's, like we were talking about before, there's just so much wisdom out there that having partners like you and having guests like you is certainly invaluable. So we thank you for coming on and sharing your knowledge with us.
Yeah, no problem. I have no problem with talking. After 500 podcasts, these are easy for me. And anything Tom wants me to do, I will do.
He's going to cheer for the Yankees.
That's a very scary statement. But hey, you know what? We'd definitely love to have you on again in the future and talk more. Obviously you're a wealth of knowledge. Family office style planning is very
IBC. I'd love for people to know,
Sure.
about what you do. You're one of the leaders in that from our organization. So,
well, I appreciate that. And then also that we have we can talk about Roth conversion strategy using developmental multifamily complexes from the ground up. It's another really good Roth conversion strategy. So that would be another great topic.
Here we go. 2025. You're on the calendar.
Yeah.
We got you.
So let's make sure we end this by saying to our audience,
again,
this is something you need to run by your accountants, your attorneys, your tax attorneys, whoever you're taking financial advice from. We are not giving you financial advice at this moment in time. Check with your financial professionals.
Yes.
I hope compliance is okay with that.
Yeah. And no returns are guaranteed, right? There's always a chance of
always a risk
losing everything, right? So
absolutely.
Check those boxes, and if it's right for you, you can give Bruce a call. Bruce, does your company take direct calls, or do you guys just through advisors?
No, we take direct calls, and then they can get it to me. But I have no problem with giving out my phone number.
Yeah. Or your company's number, so that we, if people are non-clients of ours, if you're a client, you'd call Tommy and I, or if you want to be a client.
Yeah. Well, I would encourage people to call you first and then get a hold of me. But if you want to get a hold of me, I'm BWEHNER @3 wealth.com. And I'm trying to decide whether we should do a telephone or not.
Office number.
What's that?
If you're going to do one, do the office number, but we could always put everything in show notes.
Yeah, let's do the show notes. I feel better that.
You got it.
All righty, folks. Well, thanks again, Bruce and Tommy. Another great episode.
Yeah, we're coming. How many are we? We're coming up on 100, right?
Coming up on 100. Yep. Yes, sir.
Congratulations.
Thanks.
So
now if we can get residuals like Gilligan's Island, we'll do great.
So hopefully, Tommy, the next time we talk, the Dodgers won't have a World Series, because for Padres fans, that is basically our version of a World Series win. And folks, we hope you enjoyed today's podcast, and you just continue to retire happy. Take care, folks.
Take care.
It's easy to get in touch with John and Thomas. If you're more on the West Coast, give John a call at 858-758-9889. That's 858-758-9889. Or go online to GoSecurus.com. That's GoSecurus.com. If you're more of an East Coaster, then call Thomas, 973-394-0623. That's 973-394-0623. And online at internationalfinancial.com. That's internationalfinancial.com. And you can, of course, always just check the description of today's show for all that contact information. Don't forget to subscribe and follow the podcast on your favorite apps, and we'll see you next time on the Retire Happy Podcast.
Investment advisory services offered through Brookstone Capital Management, LLC, BCM, a registered investment advisor. BCM, Securus Financial, and International Financial Advisory Group are independent of each other. Insurance products and services are not offered through BCM, but are offered and sold through individually licensed and appointed agents. The opinions expressed by John Amarino, Thomas O'Connell, and guests on this show are their own, and are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Investments involve risk, and unless otherwise stated, are not guaranteed. Past performance cannot be used as an indicator to determine future results. Any strategies mentioned may not be suitable for everyone. Information expressed does not take into account your specific situation or objectives, and is not intended as recommendations appropriate for you. Before acting on any information mentioned, please consult with a qualified tax or investment advisor to determine if it is suitable for your specific situation. This program is designed to provide accurate and authoritative information with regard to the subjects covered. Registered investment advisors and investment advisor representatives act as fiduciaries for all of our investment management clients. We have an obligation to act in the best interest of our clients and to make full disclosure of any conflicts of interest. Please refer to our firm brochure, the ADV 2A Item 4, for additional information.